Hi, at this time of the year it's customary to look at the year that's just passed and make some forecasts for the year ahead. Well, I think 2010 is going to be remembered as the year that the property market stalled. Rising interest rates, decreasing affordability and economic uncertainty were a volatile mix that stalled the property boom that we experienced in the first half of the year. Now, while many property buyers think Christmas has come early, some homeowners and I guess some investors are concerned about the bad news they're reading. Yes, property prices are flatlining and auction clearances have fallen and there are more properties on the market now than there are potential buyers. But nothing suggests that the property market's about to crash. Now, before I discuss a bit more about where the market's heading and what's in store for next year, I'd like to mention these new video programs that I've recently released. There's the first one, which is how to build wealth through property investment, and this is 2 videos, 4 hours, explaining my strategies that have helped me trade through, it's now 7 property cycles that you can use to see you through this coming year. And you can buy it in a set if you like, together with this excellent program about the mindset of successful property investors. If you click on the link below, you'll find out all about this. Okay, now when you look at the market data and what's happened in the year just gone, what the data doesn't show is how fragmented the markets really are. What I'd call A-class properties, properties in prime locations, properties with an element of scarcity, they're still selling well. Look, even though clearly there's less interest from both owner-occupiers and investors than there was before. However, B and C-class properties, they're just not selling well at all. Some have dropped in value, some even 10%. Some can't be given away. Well, actually it's not really as bad as that, but you'd have to give them at a very steep discount to get somebody to buy them. But all the key indicators suggest that the slowdown is going to continue well into the first half of 2011. The number of properties on the market is high at the moment, and many vendors, sellers, still have got unrealistic expectations. They'd love to get those prices that they may have got 6 to 9 months ago. But unfortunately, they're going to be disappointed, aren't they? Properties are remaining on the market longer for sale, and more vendors are discounting their asking price to sell their properties. Rising interest rates and the prospect of further increases next year mean there are fewer home hunters competing for those properties for sale. With more properties for sale, which means more choice for buyers, and the longer homes take for sale, meaning they're likely to go for a lower or more reasonable price, that suggests that we're in a buyer's market. Okay, so what's ahead for 2011? Looking forward, it looks like it's going to be another year when our markets are fragmented. The value of certain properties is going to keep increasing, others will stagnate, and certain properties are going to fall in value. However, it's very likely to be the year that rents are going to increase strongly in most areas. You see, I see minimal growth and more likely falling values in some of the outer new home suburbs and in some of the cheaper suburbs where rising interest rates are going to hit the hardest. In contrast, many inner and middle ring suburbs, where there's increasing demand from owner-occupiers and investors and tenants who are going to want to rent those properties, I think properties are going to maintain value in those areas. You see, the tight lending criteria has meant that many developers just aren't able to build the medium and high density apartments required in those inner and middle ring suburbs. Not the inner city areas where there's too much. There's lack of new rental stock coming in though in those inner and middle ring suburbs where there's a large demographic, 20 to 24-year-old people moving out of home now and they're wanting to rent, but our vacancy rates are at historic lows. This situation is unlikely to change for a couple of years yet. Why? Well, see, currently builders just aren't building apartments, other than in the CBDs where I actually see an oversupply looming. But eventually the banks are going to start lending to the developers again. But with the time lags involved in getting the developments on stream, it means there's going to be quite some delay before they happen, and that means our vacancy rates are going to remain low. It'll be a while before they improve. Also, that means that rents are going to rise. So even though house price, I'm going to try and say that once more, even though house price growth has stalled, our capital city populations are increasing at the highest rates of all the Western countries. We're having about 150, 160,000 new households formed each year in Australia. And each of them needs a home. And when people can't afford to buy, they have to rent. And this means that capital city rents are likely to keep rising significantly over the next couple of years. This means that if you want to increase your wealth through property and take advantage of this new buyer's market, then 2011 is going to be a great year for you. But you need to buy the right type of property, one that's bought below its intrinsic value in an area of strong long-term capital growth, and one with a twist. Well, something with something special, scarcity, something you can add value, something special. They're the properties that are still going to do well. And number two, you're going to have to structure your finance correctly to allow you to cope with the changing interest rate environment we're moving into. Now, I'm sure as the new year rolls on, there's going to be lots of chicken littles back yelling the sky's falling because interest rates are going to increase and affordability is going to bite in some areas. However, smart investors are going to be out buying. Well, they're going to be out buying the right type of property. Sitting on the sidelines, waiting to see how things pan out may seem safe for some. But it's likely to mean that you're going to miss out on some great opportunities. It's easy to do nothing. As Donald Trump said, nothing's easy. But who wants nothing? Now, this is my last market commentary for 2011. But I'm going to keep you updated with changes happening in our property markets in future editions of my Property Update e-magazine and through my daily blog. So you can always subscribe to my blog just by clicking on the link above there, and you're going to get that regularly right over the summer period. But it's also probably appropriate to remind you that if you want to take advantage of the property markets in 2011, no one can quite help you like the independent, unbiased property investment strategists at Metropole. Remember, the multi-award winning team at Metropole got no properties for sale, so the advice is independent. It's unbiased. If you want to find out a bit more about what's happening in your local market, what's in store, what our research suggests, why not join us at a free briefing in Melbourne, Sydney and Brisbane? Just click on the link below and find out more and reserve your place. And as I said, with so much happening in our property markets nowadays, I keep you updated, almost daily in my blog. So just click on the Michael's blog link up there and subscribe to it. That's a different subscription to my regular newsletter. It gives you my short daily updates. I look forward to giving you future updates real soon. This is Michael Yardney.